So specifically, I will sell my gold, which is to say, I will believe that the gold bull market is over when the following circumstances occur. It wouldn't surprise me if gold and silver prices both needed a rest. They've had a pretty dramatic uptick. A couple days ago, somebody asked me online when I would sell my gold, which is related to that question. And maybe that answer would be useful for your audience. Gold historically has done well when people are concerned about the maintenance of their purchasing power in fiat currencies and in fiat currency savings products. I share that concern. So specifically, I will sell my gold, which is to say, I will believe that the gold bull market is over when the following circumstances occur. We have a balanced federal budget. When we have a fiscal agreement in place that will allow us to honor or repudiate $100 trillion in the net present value of unfunded entitlement obligations of the US government. That's not my number. That's the Congressional Budget Office's number, okay? So when we figured out how people your age are going to get their Social Security, or we tell them honestly that they're not going to get it, when that $100 trillion problem is resolved, I'll be looking to sell my gold. But there will be one other thing. We will have to have a real positive interest rate. When I say real positive interest rate, although the government will tell you that the rate of inflation, the rate of the deterioration of the purchasing power of the US dollar is 2.6%, any of your listeners who took the trouble to compile a list of goods and services that they consume, not that the government consumes, but that they consume, we'll see that their real cost of living is escalating at 7.5 or 8% a year, which is to say, the purchasing power of their savings is declining by 7.5 or 8% a year. Real interest rate is the calculation between the yield on the US 10-year Treasury, which is about 4.5, and the rate of deterioration of the purchasing power of the US dollar, which is more like 7.5. Historically, real interest rates in the sum of about 1.5% or 2% are considered attractive. That would suggest that the interest rate paid on the US 10-year Treasury would have to be at some number like 9, up from 4.5. So I will believe that the gold bull market is over when we balance the budget, when we resolve the entitlement problem, and when either the rate of inflation falls or the yield on the US 10-year Treasury goes up. I am embarrassed to say that I believe that there is a probability of that rather than a possibility of that. I don't want people to take my word and go huddle up in the corner in fetal position and wait for a liquidity event. But I think the truth is that there are too many scary things out there. There is too much ideological division in the country and in the world, and there are too many harbingers that are negative as opposed to positive. So while I'm not saying that I think that a liquidity event is either inevitable or imminent, I think it's a probability rather than a possibility. I think it is a contingency that I absolutely positively have decided in my own portfolio to insure against. I'm running way more liquidity in my own portfolio than I otherwise would.
Tonight, we turn our attention to a veteran of precious metals and credit markets, Rule, who lays out the precise conditions under which he would sell all his gold. You heard that? Right. Rick Rule, one of the most prominent voices in resource investing, says he's not just holding gold for the long run. He's also clearly identified the rare set of macroeconomic circumstances that would make him exit this position entirely. And if you're a gold or silver investor, or even watching the bond markets closely, you'll want to hear every word. Let's unpack what he's predicting and what it means for your portfolio. Rule begins by acknowledging.
I think people need to decide for themselves, and I would hasten to remind your audience that I'm not an economist. I'm a credit guy. It is with my credit hat on that I'm afraid about Liquidity. Am I saying this is going to occur? Am I trying to scare your listeners? No. But you asked me the question around a liquidity event. Uh, and you rightly stated that in a liquidity event, all asset classes get hurt because the decision isn't made by a rational investor. It's made by a terrified investor. And more importantly, the decision is made by a margin clerk. And the margin clerk doesn't
Yes.
care what your preferences are in your portfolio. They sell whatever has a bid. It's also instructive to know that while all asset classes fall, the better asset classes recover more quickly. So in 2008, as you suggest, gold held up for a day and then sold off. But interestingly, the Fed's response to 2008 was to lower nominal interest rates and flood the market with liquidity, which caused gold to come back very, very quickly. So your investors need to remember that part of history too. Again, you need to describe yourself as an investor. If you use the word trade, the gold stocks in the last 12 or 13 weeks are up very, very, very nicely. If your orientation is to the quarter, when you're in a melt up, you have to sell. That's what you have to do. If you bought these things because you think they were underpriced and you thought when money came into the trade that they'd go up in price, the reason that you own the stock is gone. It happened. So you sell the stock. I'm an investor. I'm not a trader. If somebody gives me too much money too quickly, too easily, I will certainly take it. But my orientation is longer term. Today's gold prices are not baked in the cake with the market valuations of today's gold mining companies. As an example, we've been advising people for a very long time to own Agnico Eagle, the highest quality of the gold miners. And Agnico Eagle has done spectacularly well in the last 12 months, up 60 or 65%. We ran valuations on Agnico Eagle a year ago at
You've heard the
$2,700 per GEO
headlines.
gold.
Gold recently hit a record
They're an
high, leaping
unhedged
over
producer selling gold at
$170
$3,200.
in just over a
We had
week. But what if we told you that
estimated
the
that
real
Agnico Eagle
story
would
isn't
generate about
gold's
$5
rise,
billion
but
in
what's
cash flow
quietly building beneath it?
in
Veteran investor Rick Rule
2025.
is
And
sending
we
a
thought
clear
it was
message. While
better
gold
than
has had its
appropriately
moments,
valued. We thought it was
silver
cheap,
is the one to
particularly relative
watch.
to the
And
quality of the
according to
company.
Rule, we are
At
standing on the edge of a rare,
$3,200 gold,
generational
they're going to
opportunity.
generate
Silver has
6.5 or
always been a
$7
shadow
billion,
player, more volatile,
which means
more
that
overlooked
even
than gold.
after the run-up
But
in
history
price,
tells us something
they are
important.
not
Every
unattractively
time gold
priced.
spikes,
That doesn't
silver
mean that the
doesn't
gold
just
price
follow, it
couldn't fall back
explodes.
to
In
2,750.
1980 and again in 2011,
It
gold's
doesn't
rise
mean
laid
that
the
Agnico
foundation
Eagle
for
couldn't
silver
decline
to
by
rocket from under
25%.
$10 to
But I
nearly
think it's
50 in record
highly
time.
likely
Rick Rule believes that
that
same pattern is playing
while
out
you
again.
might not be
Gold
happy
has
as a
made its
trader
move.
owning
Now,
Agnico Eagle
silver
2.5
is
months from
cooling,
now or 3
tightening,
months from
waiting
now,
for the right moment to
I'm not
launch.
making a market
And when
call,
it
by the way,
does, it
but
won't
it's
be a
not
slow
unlikely that
crawl.
that would occur.
It will be
I think
fast,
3 years from now, you're
aggressive,
going to be
and impossible to
ecstatic
chase.
owning Agnico Eagle. I
Well,
when
I
people asked me before, a year ago, so the gold prices run, but the gold miners haven't run. Why is that? That one's simple. The gold price ran until 13 weeks ago because of central bank buying. The retail and institutional buyer was non-existent. The buyer in the gold space were central banks, and they don't buy stocks. 13 weeks ago, life changed. You began to see real inflows into the retail physical ETFs, which is to say that living, breathing human beings started buying gold, not just central banks. And you got real earnings momentums in the gold stocks. And so some of the retail money that had been in other sectors of the equity market began to go to gold. There's a wonderful index, the Bloomberg Earnings Momentum Index. And traditionally, that's been big tech. That's where the earnings momentum has been. I think the last time I looked, 12 of the top 50 in US earnings momentums were gold mining companies. And that attracts investors. And that game's not over. As you suggest, there are going to be quarterly surprises uh, that are going to take people's heads off in a positive sense. Now, how long this trade lasts as a trade is a different question. For me, as an investor, if I believe, which I do, that over 10 years, the purchasing power of the US dollar declines by 75%, And I believe that it's likely that a concomitant increase occurs in the gold price. While there could be a trading interlude where the gold equities trade down, the valuations, the hard valuations, the cash generating capabilities of gold mining companies will, I believe, increase for the whole decade. You need to understand that the junior miners as a class are valueless. If you merged every junior miner in the world into one company called Junior Explorer Co., and you looked at the money that they generated either by profits or by M&A, as opposed to the money that they spent on G&A and exploration, that business, Junior Explorer Co., we'll call it, would lose $2 billion a year or $3 billion a year. So what do you pay for a business that loses $2 billion a year? Do you pay 8 times losses? 12 times losses? That disguises the fact that within this 3,000 company universe of Flotsam and Jetsam, 10% of the issuers generate such spectacular performance that they add legitimacy and even luster to what is effectively a bankrupt sector. There will be spectacular amounts of money made in mergers and acquisitions and discoveries in the junior sector. But those gains will be limited to the people who have the knowledge and do the work to separate, in movie parlance, the good from the bad from the truly ugly. So the headline answer to your question is yes, but there's a big qualification. To play that game, you have to do the work. Make no mistake, if you buy the GDXJ may escalate with the gold price. It may escalate from M&A, but you are owning in that index a whole bunch of stocks that you otherwise wouldn't own with a straight face. I think if somebody has a short-term orientation, if they're a trader, that the momentum is with gold today. Uh, Platinum is not in my investment account, it's in my speculative account. I own platinum because I think the zeitgeist, the narrative, is wrong. The narrative is that the internal combustion engine goes the way of the dodo in 2030, and the need for auto catalysts goes away in 2030. I believe the internal combustion engine goes away in 2065 or 2070. And so demand for auto catalysts continues for 35 years. On a net present value basis, I add a value tail, and other analysts don't. I also own platinum because I think the potential for political disruption in South Africa and or Russia, which is where platinum comes from, are high. And if you had a hiatus in supply, the price goes crazy. Here's why. $125 worth of platinum in a catalytic converter enables the sale in the Western world of a $50,000 or $60,000 car. If the price of platinum doubled,
The recent bullish performance of both gold and silver, noting that while prices may need a short-term breather, the long-term bull case is still intact. But then, he gets to the heart of the matter. He will only sell his gold when 3 conditions are met: a balanced U.S. federal budget, a full fiscal solution to the $100 trillion in unfunded entitlement obligations, yes, $100 trillion based on Congressional Budget Office data, a real, positive interest rate environment. That last point is critical. Rule argues that the U.S. 10-year Treasury may yield 4.5%. But real inflation, the actual deterioration in purchasing power, is more like 7.5% to 8%. He makes a clear case that true positive real rates would require treasuries yielding upwards of 9%, which is far from today's reality, until these 3 unlikely stars align. Rule remains firmly bullish on gold. Now, why should financial investors care? Because, according to Rule, the probability of a liquidity crisis is no longer theoretical. He doesn't say it's imminent, but he urges caution. There are too many red flags: deep ideological divides, unsustainable debt, and geopolitical uncertainty. His personal portfolio, significantly more liquid than usual. He's hedging against a systemic shock and warns investors to do the same. He reminds us what happens in a liquidity event. It's not a rational investor making the sell decision, it's a margin clerk. And the margin clerk sells whatever has a bid. That includes gold. Still, Rule points out that while gold may dip in such a panic, history shows it recovers fast as it did after the 2008 crash when central banks slashed rates and flooded the system with liquidity. Gold's resilience isn't a myth, it's a historic pattern. But this bulletin isn't just about macro theory, it's also about specific investment strategy. Rule names Agnico Eagle as one of his top gold miner picks, highlighting its 60 to 65% performance over the last year. Even with gold at $3,200, he believes the stock is still undervalued. Agnico, according to his internal models, could generate over $7 billion in cash flow by 2025. He calls it a long-term hold, not a trade. In contrast, Rule warns against the junior miner sector as a whole, calling most of it valueless. Out of 30,000 junior resource companies, only about 10% are legitimate performers. He suggests that those seeking exposure to juniors must do serious due diligence or risk owning garbage. Buying the GDX JETF, for example, means owning a lot of companies you wouldn't buy with a straight face. That's a stark warning. Let's shift gears. Rule also talks platinum, but not in his investment account. He holds it in his speculative portfolio. He sees supply risk from South Africa and Russia, major producers of the metal. He also believes the narrative around the death of the internal combustion engine is premature. In his view, platinum has unusual demand inelasticity, making it ripe for sharp price moves if disruptions hit supply. But this is important. He only holds platinum speculatively, not as a long-term asset. So, what's the big picture? Rick Rule paints a cautious, calculated outlook. He's not panicking. He's not calling for the end of the financial system, but he's telling gold investors that the fundamental conditions which would signal the end of gold's bull market are not even close until we see a truly balanced budget, a $100 trillion entitlement fix, and real interest rates. Gold remains a necessary part of a sound portfolio. That's the story from Rick Rule, and it should make every precious metals investor think carefully about how to allocate for the years ahead.